Topic: Asset allocation processes and the mean variance model examines the role of asset allocation in portfolio construction and the application of mean variance optimization in investment management. Asset allocation is one of the most important determinants of long-term portfolio performance because it establishes the balance between risk and expected return across asset classes. The topic focuses on modern portfolio theory and Harry Markowitz's mean variance framework, which seeks to identify efficient portfolios that maximize expected return for a given level of risk. Investors use these models to evaluate diversification benefits, estimate portfolio volatility, and construct optimal portfolios. The topic emphasizes that disciplined asset allocation frameworks are essential for managing risk, improving diversification, and supporting long-term investment objectives. Mean variance optimization is the central analytical framework discussed in the topic. The model evaluates portfolios based on two primary characteristics: expected return and variance, or volatility, which serves as a measure of risk. By combining assets with different expected returns and correlations, investors can construct portfolios that improve risk-adjusted performance through diversification. The efficient frontier represents the set of portfolios offering the highest expected return for each level of risk. Investors select portfolios along this frontier based on their risk tolerance and investment objectives. The topic highlights that diversification benefits arise because asset returns are not perfectly correlated. Consequently, portfolio risk can often be reduced without proportionally sacrificing expected return, making diversification a fundamental principle of portfolio management. The topic extends mean variance analysis to portfolios containing multiple risky assets and introduces the concept of hurdle rates. When multiple risky assets are included, optimization becomes more complex because investors must evaluate expected returns, volatilities, and correlations across all assets simultaneously. Correlation analysis is especially important because portfolio risk depends not only on individual asset volatility, but also on how assets interact with one another. Hurdle rates represent minimum required returns that investments must exceed before inclusion in a portfolio. Investors may use hurdle rates to account for illiquidity, operational complexity, regulatory requirements, or strategic objectives. The topic explains that incorporating hurdle rates helps investors evaluate whether additional expected returns adequately compensate for increased risk or investment constraints. The topic also examines several practical optimization issues that complicate portfolio selection in real-world investing. Mean variance optimization is highly sensitive to estimation errors in expected returns, volatilities, and correlations. Small changes in assumptions may produce dramatically different portfolio allocations, often leading to unrealistic or excessively concentrated positions. The model also assumes stable return distributions and investor rationality, which may not hold during periods of market stress or structural economic change. Transaction costs, taxes, liquidity constraints, leverage restrictions, and short-selling limitations further complicate optimization processes. The topic emphasizes that portfolio managers must supplement quantitative optimization models with professional judgment, risk controls, and practical investment constraints to create realistic and implementable portfolio strategies. Another important topic discussed in the topic is adjusting mean variance optimization for illiquidity and factor exposures. Illiquid assets such as private equity, real estate, and hedge funds require additional return compensation because they cannot be traded quickly without significant cost or delay. Investors may therefore apply liquidity penalty functions or illiquidity adjustments within optimization models to better reflect actual investment risks. The topic also explores adjustments for factor exposures, where portfolio risk is analyzed based on systematic factors such as value, momentum, or macroeconomic variables rather than individual asset classes alone. Incorporating factor analysis allows investors to better understand the underlying drivers of portfolio risk and improve diversification across broader economic and market conditions. Finally, the topic focuses on methods used to mitigate estimation error in mean variance optimization. Because optimized portfolios are highly sensitive to input assumptions, investors often use techniques such as resampling, shrinkage estimation, Black-Klitterman modeling, and portfolio constraints to improve stability and realism. Resampling helps reduce the impact of uncertain return estimates by incorporating multiple simulated scenarios, while shrinkage techniques adjust extreme estimates toward more stable long-term averages. The Black-Klitterman approach combines market equilibrium assumptions with investor views to generate more balanced expected return estimates. Portfolio constraints may also limit concentration and excessive turnover. The topic concludes that effective asset allocation requires combining quantitative optimization with practical judgment, disciplined risk management, and robust estimation techniques to improve long-term investment outcomes.